Hello and welcome to my channel. In today's video, you'll learn how hyperinflation arises, the factors that contribute to it, and the effects it can have on an economy. We'll take a look at historical examples and examine the mechanisms behind this rare but extremely destructive phenomenon. So, stay tuned if you want to learn more about this important topic. Hyperinflation and currency reforms, an in-depth analysis. Introduction. Hyperinflation is a rare but devastating economic phenomenon that has profound effects on the economies it strikes. When a currency rapidly loses value and prices skyrocket uncontrollably, the economic and social fabric of a nation can become severely destabilized. In this comprehensive analysis, we explore the causes and effects of hyperinflation, review historical examples, and discuss strategies for protection. We place a special emphasis on currency reforms, which are often the last resort to combat hyperinflation and restore economic stability. Causes of hyperinflation. Hyperinflation is caused by a combination of factors that lead to a country's money supply getting out of control. A common and prominent example is excessive money printing. When a government prints large amounts of money to cover its expenses without corresponding economic growth or productivity increases, it leads to currency devaluation and a rapid rise in prices. This mechanism, often identified as the primary cause of hyperinflation, is based on the principle that an oversupply of money with a steady or declining supply of goods and services results in a loss of money's value. Another significant factor is high national debt. Governments that incur heavy debt and finance it by printing money risk losing the trust of the public and international investors in their ability to repay their debts. This loss of confidence leads to currency devaluation and further drives up inflation. A prominent example of this is the German hyperinflation of the 1920s, where war and reparation costs were covered by massive money printing. Wars and political instability can also act as catalysts for hyperinflation. Conflicts and political unrest disrupt economic infrastructure and significantly hamper the production and distribution of goods. At the same time, governments in such situations often feel compelled to print large amounts of money to finance military expenses or reconstruction efforts. These measures lead to an oversupply of money, which devalues the currency and can trigger a spiral of hyperinflation. Loss of confidence in the currency is another critical factor. When the public and international investors lose faith in the stability and value of a currency, they tend to exchange their savings for more stable foreign currencies or tangible assets like gold and real estate. This loss of confidence can accelerate currency devaluation and trigger hyperinflation. Effects of hyperinflation. The effects of hyperinflation are profound and impact all areas of society. One of the most obvious effects is the drastic loss of purchasing power. As prices rise daily or even hourly, people can afford less and less. Savings rapidly lose value, hitting the middle and lower income classes the hardest. The cost of living rises exponentially, exacerbating social inequalities. While the wealthy may be able to shift their assets into more stable currencies or tangible assets, the poorer population often has no such options and bears the brunt of the crisis. Economic instability increases. Businesses struggle to calculate their costs and set prices, making long-term investments risky. Many businesses are forced to close, leading to high unemployment. Uncertainty in the economy increases, and growth stagnates or even shrinks. The loss of jobs and rising uncertainty further deteriorate the overall economic situation, which can exacerbate hyperinflation. Social and political unrest are additional consequences. The drastic deterioration in living conditions can lead to protests and revolts. The public loses trust in the government and seeks change, which can lead to political instability and shifts in power. Hyperinflation can destabilize a country's social fabric by undermining social cohesion and creating a climate of uncertainty and mistrust. During times of hyperinflation, people try to protect their assets by investing in stable foreign currencies, precious metals like gold and silver, or tangible assets like real estate. This capital flight intensifies the pressure on the national currency and accelerates the crisis. The loss of currency value and the flight to more stable investments further exacerbate the economic situation as confidence in the currency continues to erode. Historical examples of hyperinflation. A deeper understanding of the dynamics and effects of hyperinflation can be gained by examining historical examples. Germany in the 1920s is a classic example. After World War I, Germany had to make enormous reparation payments. To finance these payments, the government printed large amounts of money, leading to hyperinflation. Prices rose so quickly that workers were often paid twice a day to shop before prices increased further. In 1923, hyperinflation in Germany reached its peak. The exchange rate of the papier mark to the US dollar was about 18,000 marks in January 1923, 353,000 marks by July 1923, and an astounding 4.2 trillion marks by November 1923. The daily rise in prices led to surreal scenes where people carried baskets full of banknotes to make simple purchases. Wages were paid multiple times a day to allow workers to spend their earnings immediately before prices increased further. This hyperinflation only ended with the introduction of the Rentenmark in November 1923. The Rentenmark was backed by real estate and aimed to restore the public's confidence in a stable currency. Additionally, drastic economic policy measures were implemented, including strict control of the money supply and restrictive fiscal policies. The introduction of the Rentenmark gradually stabilized the economy and laid the foundation for the economic recovery of the Weimar Republic in the late 1920s. Poland also experienced a period of hyperinflation after World War I. After regaining independence in 1918, Poland faced the challenges of rebuilding and integrating various economic systems from the formerly partitioned territories. This complex situation was exacerbated by the economic consequences of World War I and political instability. Hyperinflation in Poland peaked between 1921 and 1924. Prices soared, and confidence in the Polish mark dwindled. In 1924, the government implemented a comprehensive currency reform, replacing the Polish mark with the zloty. The reform was part of a broader economic stabilization package initiated by Finance Minister Władysław Grabski. Grabski implemented strict austerity measures and a restrictive monetary policy to control inflation and restore confidence in the new currency. The introduction of the zloty and the accompanying economic policies stabilized the Polish economy and ended the period of hyperinflation. These reforms laid the foundation for moderate economic growth in the following years. Although Poland continued to face significant economic and political challenges, Poland experienced another period of hyperinflation in the 1990s. After the end of communism and the transition to a market economy, Poland went through a period of economic turbulence. The rapid liberalization of the economy and the opening of markets led to a drastic rise in prices. In 1990, the inflation rate was nearly 600%, leading to a significant loss of purchasing power and widespread social problems. To address this crisis, the Polish government implemented comprehensive reforms. A restrictive monetary policy, control of the money supply, and fiscal discipline were introduced to combat inflation. Additionally, the zloty was stabilized again and pegged to a currency basket to regain the confidence of the public and international investors. These measures eventually stabilized the economy and significantly reduced the inflation rate to a manageable level. Protecting against hyperinflation. There are various strategies to protect against the devastating effects of hyperinflation. Individuals can invest in stable foreign currencies, precious metals, or tangible assets that retain their value better during times of hyperinflation. Precious metals like gold and silver are traditionally considered safe havens during economic uncertainty. If you liked the video, please give me a like, subscribe to the channel, and activate the bell so you don't miss any new videos. Thank you for watching the whole video, and see you soon.